Welcome, everyone. This is session 2 of our 10-part Pillar 2 technical series. Before we get kicked off here, I'd like to introduce myself. My name's Justin Metcalf. I'm a director with the International Tax Services Group in Charlotte, North Carolina for Forvis Mazars US. And I will here introduce my colleagues that I'm presenting today with. Carolyn, I don't want to talk for you, so please introduce yourself.
Thanks, Justin. Hi, everyone. My name is Carolyn Boschmidt. I'm a managing consultant with the Forvis Mazars US International team, and I've been with the firm for about 2 years now.
Thanks, Carolyn. Hi, everyone. So I'm Neil Rolfe. I'm standing in for Danae Fillion today. She's unfortunately slightly poorly. I am partner in our UK firm. I'm a member of the Pillar 2 Executive Committee, along with Justin, in charge of technical and training. I'm also the head of insurance tax for Forvis Mazars, and so being one of the more affected industries, part of the vanguard of Pillar 2 for the firm.
Awesome. Yeah, so as I mentioned earlier, this is the second part to our 10-part series. And today we're going to cover, I'll give a recap right after this, but today we're going to cover the beginnings of establishing your multinational enterprise group. And then next session, which will be session 3, we'll peel a layer further of the onion of what you do with more complex MNE group, multinational enterprise group structures. Today is a little more simplified. We're going to go through how do you bare basic bones, how do you establish that, and little pitfalls that would happen on the more easier end, and then save the rest for the third session, which should be in 2 weeks from now, and that will be with Rami Below and Kate Morton as well, and I will be on that as well from the U.S. side. So without further ado, let's get started. But before we do, I'd like to kind of give everyone a recap of what we did, what we discussed in the last session. So, in the last session, which was hosted by myself and Neil, we discussed, high level, right? What is Pillar 2, right? How is it enforced? And what are companies doing today, which is really running the transitional CBCR safe harbor tests. In our introduction, and this is just to kind of, the previously on this Pillar 2 session, we discussed that Pillar 2 introduces a global minimum tax that's imposed on a jurisdiction by jurisdiction basis. Thinking of Pillar 2 as one big pie where, everybody in the world is has to do some kind of compliance obligation, whether you like it or not, and I'll explain how that's enforced. There is what it does is it sets up these complex, data-intensive minimum tax calculations done on a jurisdiction by jurisdiction basis. It's enforced by 3 charging mechanisms: the qualified domestic minimum top-up tax, the income inclusion rule, and the undertax payments rule. The ordering of this is first QDMTTs come first. And what is a QDMTT? Just to give you a recap from the last session, because this will be vital to understanding the MNE group when we get into it here in a second. A QDMTT is basically a local jurisdiction minimum tax that follows the design and sets up the same outcomes as the globe model rules that were established by the OECD back in December of 2021. The next thing is the income inclusion rule, and what that is it's a top-up tax charging mechanism that starts at the ultimate parent entity of our MNE group, which we will talk about and establish that here in a second, and we'll go in depth on how you identify a UPE and how you locate one. But what the income inclusion rule says is once you've established the MNE group, starting at the top, if the UPE has a qualified income inclusion rule, it's allowed to basically collect top-up tax on behalf of its low tax constituent entities below it. Today we'll talk about what a constituent entity is and how to define that. And then there is the undertax payments rule, right? Which basically says, and to Neil's great analogy from last session, it's basically eat everyone's lunch. So QDMTT is eat your own lunch. IIR is eat someone else's lunch under you. And then the UTPR is basically eat everyone's lunch, which is, I guess, is leftovers in that context. And what it does, it basically says is if you don't collect an tax under Pillar 2 via QDMTT or IIR, you basically are, if you have a UTPR in your jurisdiction, you are given the opportunity to deny deductions in your own jurisdiction to ensure that the low tax entities in your group are topped up for Pillar 2 purposes. This is usually the most controversial of the three charging mechanisms, and it's questionable how that will come in when it comes into play in 2025. But again, this is just a recap of last session. So, the way we think of this is there is one top-up tax by jurisdiction potentially, right? And it's collected by these three charging mechanisms. The question is, how do you, and we discussed this in broader detail in the last session, but there are certain steps, right, you have to do to figure out your top-up tax by jurisdiction. And this is a recap of one of the slides in the last session. The first, as you can see here, the very first step is identify your constituent entities in the MNE group. Basically identify your base, which is the MNE group with its constituent entities. Determine who would be excluded, and identify the location of each constituent entity to see if there's any kind of stateless component, which we'll talk about here as well. The second, in the last session, once you've done that, then you can go ahead and compute your globe income or loss under Article 3 of the globe model rules. Then you can go ahead and once you've done that, compute your adjusted covered taxes under Article 4. And then under Step 4 of this, you can then apply the mechanics under Article 5, which basically say you apply your globe income and your adjusted covered taxes and compare that. Basically compare whether you're below the globe ETR and compare that to what your excess profits are. And then, of course, once you've done, and that would eventually give you what your jurisdictional top-up tax liability is. And then the last step here, which we gave a recap of, is who gets to basically eat the lunch, IIR, QDMTT, UTPR. So without further ado, right, let's start on the most important part of this topic matter is, why do we care about quantifying your MNE group? Well, the very first thing is, you're not in Pillar 2, or you're not within scope of the globe rules unless you can say that your MNE group, after you've determined that, has annual revenue of 750 million euro or more, based on its consolidated financial statements of the UPE, over a 4-year period, which looks to the current year and 3 preceding years before that. If you have 2 in the last 4 that meet this threshold, you are what we call in the soup, or in the scope of Pillar 2. So, the most important part here is we have to now determine, what is our, MNE group, and, how do we determine that? So we're going to go right into what Article 1's definitions talk about and give a little more detail around that. So I'm going to kick this over to Carolyn, and let's talk about defining your multinational enterprise group, because this is arguably the most vital part of Pillar 2. You can't go forward until you know your MNE group.
Thanks, Justin. So there are quite a few definitions that go into putting together the puzzle pieces of determining your MNE group. And again, as Justin was saying, only MNE groups are going to be subject to the scope of globe rules. So an MNE group is defined by the OECD as any group that includes at least one entity or permanent establishment that is not located in the jurisdiction of the ultimate parent entity. So there's a lot of terms in there that we need to define. So let's start with group. A group is any collection of entities that are related through ownership or control, such that the assets, liabilities, income, expenses, and cash flows of those entities are either included in the consolidated financial statements of that ultimate parent entity, or they're excluded from the consolidated financial statements solely based on size or materiality, or the fact that the entity is held for sale. So if you have an entity that's going to be held for sale, or you have a entity that is an immaterial interest that may not be included in the consolidated financial statements, you may be required to include those for purposes of determining if that entity would be considered a constituent entity of your group. Additionally, you may have entities that are located in a jurisdiction, and they may have one or more permanent establishments located in other jurisdictions. That group of entities, that main entity and the permanent establishments, may be considered a group as long as that entity is not part of another group. Going into defining constituent entities and the ultimate parent entity, before we can talk about those defined terms, we need to talk about what is an entity for purposes of the Pillar 2 rules. So an entity is any legal person other than an individual or an arrangement that prepares separate financial accounts, such as a partnership or a trust. So using this definition of an entity, a constituent entity is going to be any entity that is included in a group or a permanent establishment of a main entity, and it's not going to include any entities that qualify for excluded entity status. And we're going to talk about which entities qualify for excluded entity status in a different segment later in this session today. Ultimate parent entities, or UPE, that's going to be any entity that owns directly or indirectly a controlling interest in any other entity and is not owned with a controlling interest directly or indirectly by another entity. So an entity cannot be considered the UPE of a group if there is another entity higher in the ownership chain that is required or would have been required under acceptable financial accounting standards to consolidate that entity in its financial statements on a line-by-line basis. The main entity of a group that owns one or more permanent establishments can also be considered a UPE in certain situations if that main entity includes the financial accounting net income or loss of those permanent establishments in its financial statements. So all of these definitions are really important because before a group can be considered an MNE group, this ultimate parent entity must have directly or indirectly at least one foreign subsidiary or permanent establishment in a jurisdiction outside of that UPE. Even if that permanent establishment or subsidiary doesn't earn income, that's still going to be sufficient for that group to meet the definition of an MNE group.
Yeah, and Carolyn, on establishing your MNE group, like you mentioned, and I guess this is the kicker right here. One of the most important elements is establishing what is a controlling interest, because that sets the foundation of who is a UPE. And based on the model rules OECD definition, right, which it's basically an ownership interest, which is in an entity where the interest holder, right, is required, as Carolyn, as you said, right, to consolidate the assets, liabilities, income, expenses, and cash flow of another entity on a line-by-line basis in accordance with an acceptable financial accounting standard. We'll elaborate on that point a little later here. And this is where you have this is what's often known as like the deemed consolidation test, would have been required to consolidate the assets, income, liabilities, expense, cash flow of the entity on a line-by-line basis if the interest holder had prepared consolidated financial statements. This is where it gets a little tricky, right? Because you have your rather straightforward examples where you have this basically consolidation regime that most people follow as the acceptable financial accounting standard. But Carolyn, you mentioned earlier here permanent establishments and main entities, right? To those permanent establishments, some business operations may have above 750 million euro into the last 4 years and not really have true entity structure types, but do have a permanent establishment that's in accordance with an OECD model tax treaty, right? So here is where the second bullet is where it gets a little tricky with understanding who the UPE could be in some of these more complex structures. Again, we're going to elaborate a little more on that in the next session, but I did want to kind of touch point on this here. So, Carolyn, I'll kick it right back to you there.
Thanks, Justin. I mean, I think controlling interest here, this definition is definitely important for determining what constituent entities are going to be in scope and included in the MNE group. But I think the next couple of slides actually are going to define permanent establishment and then go into a couple of the other different types of entities that we've been seeing in our client structures and how the Pillar 2 rules apply to them.
Yeah, so kicking it back there, right? So we mentioned about I gave everyone kind of the Easter egg about permanent establishment. So it's basically defined under the OECD rules as a place of business situated in a jurisdiction and treated as a permanent establishment in accordance with an applicable tax treaty in force, which is usually either off of the OECD model tax treaty, or in our cases, in the U.S. side, could be the U.S. model tax treaty, such that the jurisdiction's taxes that income attributable to this deemed establishment. This is where it gets a little bit tricky, and you might have some conflicting pieces about, okay, how do I go about this? But generally the tax treaty governs in this aspect. We were talking earlier about MNE groups just in general, right? How, like, where you're straightforward fact pattern. So most companies that are attendees today have a simple U.S. corporation with a or a U.S. entity type that owns simple entities that have been entitized in the U.S. There are a little bit of different rules in the GLOBE rules, specifically with what we call joint ventures and JV groups. The JV groups, for purposes of GLOBE, are treated for the most part as multinational enterprise groups within multinational enterprise groups. So, what is a joint venture, right? And so let's first ask, what is a JV group? It's basically a JV and its JV subsidiary. So what is a JV? A JV, they're not treated as constituent entities of an MNE group because their income, expenses, assets, and liabilities are not consolidated with the rest of an MNE group on a line-by-line basis. If you recall our piece about controlling interest, here is what kind of sets up the foundation of having an MNE group within an MNE group. That said, right, the low tax income of a JV or of a JV group does come into the broader MNE group through its top-up tax computations. The key thing here is to look for, where you have a related party that owns 50%, at least 50% of an ownership interest, with sharing with an unrelated party, to kind of trip up these rules and establish a joint venture for purposes of the GLOBE model rules. A JV subsidiary is basically, it is what it sounds like. It's an entity that is owned by a JV, right? That is defined under the model OECD rules, that rolls up to the JV at the end of the day. So, when you're thinking about this MNE group within an MNE group structure, you need to think about the income, assets, liabilities, and expenses, and all the other GLOBE attributes that we talked about in the first session coming into the broader calc through this JV. But the JV itself is basically treated as a multinational enterprise group within the multinational enterprise group. So, continuing on, right? The next question, right, is, sorry, one second here. In our next slide here, right, we've established at this point what are the different entity types you can have, right? So you can have constituent entities, you can have a UPE, as part of your M&E group, you can have a little bit of a more complicated fact pattern where you have, a JV with JV subs. You can have PEs or a PE group. The key thing is the question now becomes, how do you define the location of a constituent entity under the Pillar 2 rules, because as we said in the last session, Pillar 2 is basically a new foundation of rules, right? So, thinking about how, U.S. sourcing rules and thinking about how non-U.S. sourcing rules are, you have to ask yourself, how do you source income under these M&E groups? And it's basically by looking to the location of the constituent entity. And there is this element of identifying stateless entities, right? So, and for those interested, this is under Article 10.2 of the OECD model rules. So let's start first when you have a permanent establishment, right? So there is generally like a pecking order for determining. So, when you have a constituent entity and a UPE, that's usually relatively straightforward in most cases because you generally know where the entity is located. But when you got a permanent establishment, right, that, in this case where there is no entity type, there is a pecking order under the OECD model rules under Article 10. So, this pecking order, it says is you first start, looking specifically to whether the jurisdiction you're in has an applicable tax treaty, right? So if the permanent establishment is a place of business situated and treated as a permanent establishment based on that applicable tax treaty, the jurisdiction, the PE jurisdiction that's based off the tax treaty is where that entity in question is located. Let's say there is no tax treaty, right? Let's say it's like like, for example, like the U.S. doesn't have tax treaties with a lot of Latin American countries right now. I mean, I think we have we're starting to get there, but we're not there yet. Some of these no tax jurisdictions. Well, the next piece is what we've coined as taxable presence jurisdiction. You look to that, and what that means is basically if a permanent establishment is located in a jurisdiction with no tax treaty but has income that would be subject to tax by a jurisdiction on a net basis, kind of similar to our like U.S. effectively connected income regime. The jurisdiction is located where it is taxed on a net basis. So that would be the second pecking order of determining the PE's jurisdiction. The third, if it's unclear whether you have that you don't have a treaty and it's unclear whether that jurisdiction is taxed on a net basis, the next in the pecking order is what would the OECD Model Tax Convention jurisdiction say this entity is located? And if that is the case, it's the jurisdiction that meets that definition in the OECD Model Tax Convention. Now, let's say all three of those are unclear. You don't have a treaty jurisdiction, right? Because there is no applicable tax treaty. The jurisdiction you're in does not tax you on a net basis, that income on a net basis, and your fact pattern does not fall in with respect to this entity in the OECD Model Tax Convention. You are then now treated as what we call a stateless entity. And stateless entities, right, this is, are basically jurisdictions that have no, that for minimum tax purposes, don't have a true location because it's rather unclear. If you have stateless entities in your M&E groups, could have stateless entities inside their M&E group, but if you do have that, the jurisdictional minimum tax computation kind of then says we need to now create this as the stateless entity jurisdiction, right? So one of the things that often come up in the practical sense is Mexican maquilas, for that matter. It's that's in a lot of OECD commentaries, and the tax community, maquilas are relatively fluid in this aspect, where they're treated as stateless jurisdictions, where you can have, so let's just say you had a Mexican true constituent entity, right, that was located there, and you had a Mexican maquila that met the definition of a stateless entity. You could technically have two top-up tax calculations going, one for Mexico, and then I guess stateless entity dash Mexico, which is a separate one. So having a stateless entity relatively does complicate the M&E group determination and the top-up tax calculations as you're going through them. That being said, that's with respect to PEs. Then there's this distinction between flow-through entities and non-flow-through entities. So let's tackle non-flow-through entities. I elaborated here that for non-flow-through entities, which is corporate structures in general, right? Location is determined based on the tax residency in the jurisdiction where there is a place of management, creation, or some similar criteria, right? And this is more commonly for most client fact patterns. That if that can't be determined of tax residency, it's based on where the jurisdiction is created or organized, which we call creation jurisdiction as the pecking order. Usually non-flow-through entities will fall under one of these two things. However, flow-through entities, so you generally will not have a stateless entity in a non-flow-through entity type structure, right? Unless there's a PE somewhere. That said, flow-through entities could complicate the MNE group determination and determining where the income is sourced. For flow-through entities, let's define what that is. The OECD rules say it's an entity is a flow-through entity to the extent it's fiscally transparent with respect to its income, expenditure, profit, or loss of the jurisdiction where it was created, unless it is a tax resident and subject to covered tax on its income or profit in another jurisdiction, elaborating to maybe it's a PE. So if it's truly fiscally transparent, you now have a new pecking order you have to think about. And location for these flow-through entities is, you ask yourself first, is this potential flow-through entity, is it the UPE of the MNE group, or is the entity required to apply the IIR as an intermediate parent entity, right? Meaning like, for example, the US in most client fact patterns, we all know the U.S. has not adopted Pillar 2, so you go down a tier to find who has the next order for purposes of applying the IIR. You can have an entity under the UPE that becomes a intermediate parent entity for purposes of collecting top-up tax under the IIR. So if you're one of those, the location is where the entity was created, but if this flow-through entity, right, does not have is not the UPE that's in question, or it's not an intermediate parent entity, then you generally default to having a stateless entity similar to the PE rules we just discussed earlier. So you can have multiple, and this is where these kind of sandwich structures in the US, and we'll talk about this again a little more in detail in the next session, but this is kind of the Easter egg about talking about where you have these US sandwich structures. US owns foreign, foreign owns US, and whatnot. And let's say the third tier is like a true PE. Here's where Pillar 2 gets a little more convoluted and complicated. So that said, let's kick it off to the next. And I think we're up for a polling question here.
I think right before the polling question, though, we were going to just talk a little bit about this illustrative example of the MNE group definitions and concepts here. So we'll get to a polling question on this next slide. But before that, let's take a look at this example here. We have a U.S. parent company. As you can see, it's not owned by any entity directly or indirectly higher up the chain. So it is considered the ultimate parent entity of this group. It has it wholly owns a Dutch company, a U.S. LLC, and a German PE directly. Those are considered constituent entities of the UPE, and you can see also the indirect corporations below that will also be constituent entities of that U.S. parent company. And so because this U.S. parent company has constituent entities in jurisdictions other than the U.S., which is its own jurisdiction, this group together will be considered an MNE group. But I know we're anxious to get to that first polling question. So without further ado, our first polling question is, which of the following types of entities may be considered a constituent entity of an MNE group? So we have a corporation located in a jurisdiction other than the jurisdiction of its ultimate parent entity, a permanent establishment located in a jurisdiction other than the jurisdiction of its ultimate parent entity, a branch located in a jurisdiction other than the jurisdiction of its ultimate parent entity, or all of the above. Okay, it looks like most got it right, so that's awesome. It is all of the above. Again, when we're looking at an MNE group, the ultimate parent entity has to have subsidiaries. It can be a corporation, a branch, a permanent establishment, in a jurisdiction other than its own jurisdiction, and that will constitute an MNE group. So great job, everyone, on that. And the next section we're going to talk about is excluded entities. So these will be entities that are outside of the scope of the GLOBE rules. They will not be considered constituent entities. And I think that Neil is going to talk about that for us.
Yeah, thank you, Carolyn. So this is a realization from the OECD that not every entity that exists in the world should suffer a 15% minimum tax. So there are some entities, and the next slide covers exactly which ones, but where the entity or the subgroup involved should have preferential tax treatment, and where you fall within these rules, so where you're an excluded entity or part of an excluded entity subgroup, then you take those entities outside the GLOBE rules. They don't have to be included within a jurisdictional calculation of IIR or UTPR or indeed QDMTT, the your own lunch measure. Apart from for one important reason, so one exclusion from the excluded entities exclusion. There's a lot of exclusions there, but one area where you do have to include these entities is in the revenue threshold test. So if you have governmental entity, for instance, an excluded entity which has 750 million of revenue, and otherwise it itself is not included, and then it has subsidiaries which are not excluded. They may be relatively small subsidiaries, but let's say 20 million of revenue. Those subsidiaries are still within the GLOBE, the ambit of the GLOBE rules, by virtue of adding the 750 million excluded entity to the 20 million of non-excluded entities. So you can't just get out of the GLOBE rules by virtue of having, big excluded entity and smaller non-excluded entities. The excluded entities, as the rest of this, as the last bullet point on this slide says, they also are not included in the single GLOBE information return for the group. By the way, I'm just starting to go through the questions because I have slightly less slides than everyone else, so I haven't finished the first question because it's a little bit complicated, but I will get to your questions as we go through. Any that I can't answer, will answer after this presentation. So then what are the excluded entities? Those that the OECD has decided it would be wrong for the rules to apply a 15% minimum tax to. So governmental entity, so this is something which is either a part of the government, so it's an arm of the government. We've seen some of these, particularly in the Middle East, and you have something which is an investment arm. It's actually not distinguishable from the government itself, or it can be wholly owned by the government. So you could have, and often do have, investment entities. So for instance, GIC, the Singapore Sovereign Wealth Fund, or the Nordic Sovereign Wealth Fund, they are investment entities which are wholly owned by a government, and it was decided that it didn't make sense for tax to be levied on those because it's effectively government money in the first place. So the whole purpose of a tax is to be taking money into governments, so you shouldn't be taking money out of governments in respect of it. Similarly, international organizations. So this is where you have something which is comprised of a selection of governments. So I think the OECD, for instance, it also must have headquarters in the jurisdiction it's established, and it must prevent its income from benefiting private persons. So it is more or less a charity. And charities, non-profit organizations, those are also excluded. Again, you wouldn't want to be taxing those at 15%. So if it's been set up exclusively for religious, charitable, scientific, artistic, cultural, athletic, educational, or other similar purposes, or environmental protection, then you can end up in this bucket. And I mean, we have seen this in some cases where we've had a US charity, maybe say a medical charity, but then it owns for-profit organizations that feed up into that. So the charity itself is excluded, and no tax relating to the charitable works is going to be levied. But if there are subsidiaries which sit outside of that charity, and the charity is the big bit, let's say it's got 700 million of revenue, and the other subs have got 100 million of revenue. Those other subsidiaries, which are operated on a for-profit basis, with the for-profits then feeding up into the charity, those for-profit businesses can be subject to GloBE. And as we've just described, they would, in that case, as I've just said, 700 plus 100 is above the 750 million euros of revenue. So that situation, those for-profit subsidiaries would be within GloBE. Pension funds are excluded because pension funds typically across the world are roll up on a non-profit, a non-taxed basis, and taxes on the individuals when the pension is paid out. Similarly, investment funds often carry a tax-favoured status, so the investments roll up in some form of tax-favoured manner. So it doesn't make sense to subject those investments or the profits arising there, the investment profits at 15%, as long as it's an ultimate parent entity. Now, we and the real estate similarly, where it's an ultimate parent entity. We have seen, and we do see quite a lot of instances, certainly in the insurance world, where the subsidiaries, or where you have a sort of controlled investment fund, and that investment fund is consolidated because more than 50% of the investment fund is owned by the insurance company. The same would apply in any other sort of investment scenario for a non-insurance company. And because it consolidates up then, and it's not an ultimate parent entity, then you do have to consider it for the purposes of the GloBE rules. And it does provide some of the more complicated elections, which I think we will be covering as part of a later seminar topic, the 7.5 and 7.6. They're called the tax transparency and the taxable distribution method exemptions, elections, sorry. So I think that's all I wanted to say on that slide. It's not just the exempt entity itself which can be exempt, also subsidiaries can be exempt. The situation would be, let's say, the Singapore Sovereign Wealth Fund. It may invest in holding companies which invest on its behalf. Those holding companies, if they're owned, 95% owned by the exempt entity itself, and all they do is manage or more or less all they do is manage the investment of those funds, then again, that's more or less government money is the thinking. So as long as you meet those tests, you would also be an excluded entity and you shouldn't be subject to the 15% minimum tax.
Thanks, Neil. If I could just interject here and cover more explicitly the ownership and activities test. So for instances like you were discussing before, where you had a charitable organization that was required to have subsidiaries that were performing operations outside of the charitable functions of that entity, we can apply a test to these excluded entities where they're owned, or we can apply a test to these entities that are owned by excluded entities to determine if they themselves can be excluded entities. And it's an ownership and activities test. So we're looking at 95% of the value of the entity must be owned directly or indirectly through a chain of excluded entities. And that entity must operate exclusively or almost exclusively on behalf of that excluded entity or only carry out activities that are ancillary to those that are carried out by the excluded entity. I think our next slide here, we were going to talk about a bright line test specifically for nonprofit organizations here. Neil, if you want to talk a little bit about that.
Yeah, that's right. Yeah. So I think where you have nonprofit organizations and can be quite difficult and has been quite difficult, the OECD have recognized it's quite difficult to assess whether operations of subsidiaries are ancillary or whether they're not ancillary. And rather than people arguing on a case-by-case basis, they decided that some guidance would be helpful, and guidance was provided back in February 2023. So if you look at all of the group entities which don't meet the excluded entities definition, and you add up all of the revenue for all of those non-excluded entities, if it is either less than 750 million or 25% of the M&A group, if lower, then all of those subsidiaries are deemed to be ancillary and they're all out. Whereas if the aggregate revenue is bigger than 25% or 750 million, they will all be in. And so you will have to consider them to be non-excluded entities, and you will have to apply the Pillar 2 rules to them.
Does it make sense to go through a polling question real quick here, just for the interest of time?
Yeah, for sure.
Let's go. Let's jump a little further here. Just, yeah. Maybe, yeah.
So is this the one that you wanted?
Yep. Yeah, let's do this one here. Just give everyone some time to answer the polling question. You know, a couple of questions have come in. Specifically on, there was one that came in about CBCR, right? How are stateless entities is the treatment of stateless entities under CBCR relatively the same as the GLOBE rules? Neil, any thoughts on that one there?
Yeah, they're broadly, well, I haven't seen any differences between the two. I think the rules are designed to be the same. I haven't seen any differences between them.
Yeah, I think
that doesn't mean that there aren't any. Because,
yeah, I think the key thing is remembering the pecking order of the rules, right? For a lot of these stateless entities, right, it's looking to the jurisdiction, right? Basically treaty and taxing jurisdiction, which is very similar to what you do with like a PE in the pecking order rules that we spoke about earlier for determining a stateless entity. So hopefully that's helpful there. It looks like we're done with the polling question here. So sorry, let's continue on there. Looks like a lot of you. I think the answer to this is C for those.
Yeah, that's right.
That's right. Okay, well, I think our next section is going to be talking about the consolidated revenue threshold. So once we've determined our M&E group, we then have to see if it's going to meet that consolidated revenue threshold of 750 million euros. So first, we can talk about how that test is applied. So you're looking at the reported revenue in 2 out of at least 4 fiscal years immediately preceding the tested fiscal year to determine if the constituent entities that make up the M&E group will be in scope. So note that we're using a 2 out of 4 years test to reduce volatility in the application of the rules, excluding the current year's results from the revenue threshold test, that tested fiscal year. It'll ensure that an M&E group knows at the beginning of the fiscal year whether it will be subject to GLOBE rules in that year. Proportional adjustments may be required for instances where a fiscal year is less than a 12-month period. For instance, you may have a situation where an M&E group may have recently been created, certain entities have been recently created. And it's not going to be until the third year of that entity's existence that the GLOBE rules can apply, since at least 2 prior years are going to be required to perform these tests. And if that revenue threshold is met with respect to the 2 prior years, those entities will fall within the GLOBE rules in year 3, notwithstanding the fact that they may not have 4 prior years of consolidated financial statements with which to apply the test. There is also special consideration given to the effect of mergers and demergers, and that will be discussed in a later session in this webinar series. So some accounting standards have more flexibility in how they define revenue, so the OECD has defined that for us. So for purposes of that 750 million euro threshold, we're looking at the inflow of economic benefits arising from an M&E group's ordinary activities. Net gains from investments, depending on where they're reflected in those consolidated profit and loss statements, may need to be included in the threshold calculation as well. And then the OECD has also clarified that in the event that a M&E group's consolidated financial statements are not denominated in the euro currency, the M&E group would use the average exchange rate to translate the revenue to the local currency and applying the threshold. So I think next up we have a polling question for everyone. I don't know if while we're waiting on that, Justin, if we want to take a look at any more of the Q&A questions that have come in.
Yeah, I think for the interest of time, yeah, so let's one thing that we were talking about earlier, right? And we'll talk about this after the Q&A here, and we'll get to the slide there. On the controlling interest definition, right? We mentioned earlier that there's this deemed consolidation test, right? That kind of looks, what is the if you recall it, a controlling interest, because this is what sets up the UPE, right? It's an ownership interest, in an entity such that the interest holder is required to consolidate on a line-by-line basis or deemed to consolidate, right? In accordance with consolidated financial statements. So for purposes of this, when you're thinking about consolidated financial statements, the model rules have a variety of different ways because not every company fact pattern may follow what our standard gap, IFRS, things like that. And when we think of consolidated financial statements, they're defined as the financial statements prepared by an entity in accordance with acceptable financial accounting standard, right? In which assets, liabilities, income, expense, are all consolidated as one single economic unit. The other is where an entity meets a definition of a UPE, a PE and main entity group, right? That's in the permanent establishment context. Acceptable financial accounting standard continuing on, here, the entity, and just a heads up, the polling questions we're at the third polling question for those that are tuning in. We just answered right now. There will be one more after this, just a heads up for that. Continuing on, consolidated financial statements, right? You're looking at whether there is an acceptable financial accounting standard, right? Or, whether you would have to recreate them under an acceptable financial accounting standard. What an acceptable financial accounting standard is defined as is basically two things. It looks to, international financial reporting standards, IFRS, right? That's obviously one of them. And then you're generally looking at GAAP, right? Generally accepted accounting principles that are of, a list of countries, which, obviously the United States is in there, Japan, Hong Kong, Brazil, Australia, Canada, a number of, I'd say developed countries in there. So in this context, right, you're generally looking, to see whether you have financial whether you have financial statements that would comport with GAAP to those countries or IFRS, right? That said, right, and we'll talk about this again in the next session. There are questions about, what if you have entities held for sale? Because those aren't considered on line-by-line basis. There are a multitude of rules in the Pillar 2 rules that talk about how you treat entities held for sale. And a lot of these, I'm sure there's a ton of people here that have a lot of questions on how you, treat these kind of non-material constituent entities. And there's a simplified test that came out in the June guidance of 2024 on how to attack that for purposes of a simplified safe harbor. We will cover that a lot more in depth in the third session. Again, today is mainly designed to setting up the foundation of how to quantify an M&E group, how to identify the location, how to identify who's a stateless entity. In the next session, we will talk through that there. So kicking it back to the next, keeping it going in the interest of time, because I don't think we have a whole lot, quite a bit of time here. When you're thinking about this, for purposes of the consolidated revenue threshold, right? The whole design of this is intended to have these consolidated financial statements under one common approach. And why one common approach? Because the Globe rules talk about having, these things called materially competitive distortion. So if you consolidate under one regime's accepted accounting financial standard, and you have others that are under that, there are certain distortions that could convolute the math when you're doing the top-up tax. So there is this notion that you have to have one common unified approach, and it's usually looking to the UPE or the entity that has with certain material competitive adjustments, right, to comport to the UPE. That said, let's continue on here for the interest of time. I think we can go past this on the acceptable financial accounting standard here. I think we talked about this. So, a quick piece on this, right? Material competitive distortions, right? There is this de minimis component that basically says that if it's less than euro 75 million in a fiscal year, right? That's the quantification of the distortion. It's not necessarily a materially competitive distortion, and thus you don't have to account for that. But when you're thinking about consolidated financial statements, you want to pull in all the ones in the M&E groups, and then figure out, okay, if I have, and really what we're getting at is making translation adjustments between the UPEs, consolidated financial statements and constituent entities. If the aggregate variation is less than 75 million, it's not really seen as a competitive material distortion under the Globe rules. So understanding that distinction between your UPE and the constituent entity is vital when you're applying this consolidated revenue threshold. That said, let's kick it back to here, right? So I think we covered this piece here on the UPE front. So maybe it makes sense, Carolyn, let's go back to some of these examples that we kind of jumped over just for the interest of time there, and then we can do the last polling question right after this.
Sure, that sounds good. I think some of our examples we're dealing with determining which entities would be part of the M&E group and which entities would be excluded entities. So let me pull up this slide here. So going back to our discussion of excluded entities, here we have a U.S. governmental entity on the right side of the screen. That is an excluded entity under the OECD rules. And it owns, you can see it owns several subsidiaries on the right-hand side, including a Dutch company that it owns 70%. So when we apply the ownership and activities test, in this example, we're looking purely at ownership. We're going to assume that the activities tests are met. Based on ownership alone, the US LLC, the German PE, and the Canadian entity would all be excluded entities of the US governmental entity. And the Dutch company would not be an excluded entity because it fails that 95% ownership test. In addition, the UK entity and the Bermuda entity would also fail that 95% ownership test. So in this example, assuming this Dutch company up here that we've labeled the UPE of this MNE group, assuming that this Dutch company is not required to consolidate its financials on a line-by-line basis with any other entity, that would be the UPE of this MNE group. In a second example here, it's very similar to the previous one. We have the US governmental entity again, an excluded entity, now owning 95% of that Dutch company subsidiary, so that qualifies that entity as an excluded entity. However, the UK entity is now only owned 95% by the Dutch company, and because of that dilution of ownership, the UK entity is going to fail the ownership test and will not be an excluded entity of the US governmental entity. Now, the treatment of the Dutch company and the UK company are going to depend on if they own any entities, who they are owned by, and it's just outside of the scope of this specific example here. And lastly, we had a quick example of the activities test. So in this example, again, we have our governmental entity that owns a Dutch company and US LLC. The Dutch company is providing technical support services that are considered to be ancillary in nature. They are provided exclusively for the US governmental entity. And the assets held by the US LLC, the US real property, are held exclusively for the use of the US governmental entity. Therefore, both subsidiaries likely meet the activities test. And because they're both wholly owned, they're likely excluded entities for purposes of the GLOBE calculation. So I think that takes us to our last minute here. So we'll go ahead and pop up that fourth polling question.
And, while we're answering this last polling question, on one of our discussion points, I wanted to go back to those examples because I see from some of the questions we've been getting in, questions specifically relating to how these excluded entities and examples on that. So thank you for that, Carol. And that was, I think that should help answer some of the questions here that we've been getting. And again, if we have quite a bit of questions that have come in, and if you've asked them here and we have not addressed them, I promise we will get back to you relatively shortly after the session today. We'll reach out to you personally. So okay, looks like quite a bit here. A lot, 43% are what we call in the soup. So I think that concludes our session today. I understand that today was very introductory to the MNE group pieces. I think there are some key takeaways on our concluding statements here is, understanding your UPE, understanding your constituent entities, and understanding the location of those entities is vital because and how they all interplay in your MNE group, because this is what's setting up the foundation for what we'll be discussing in about two sessions from now is quantifying GLOBE income or loss for purposes of the Article 5 calculation of the OECD model rules. Next session here, we'll which is in 2 weeks from now, we'll peel a layer of the onion, and get a little more complex in some of these complex MNE group structures, where you could have some JVs and some fiscally transparent entities that may become a stateless entity, may be deemed a stateless entity. So what do you do in those situations? And we'll have a little more examples on there. So please stay tuned. And again, we really do appreciate your time for joining. Especially, and we understand a lot of us here are under a massive U.S. tax deadline in 10/15. So your time here is greatly appreciated, and we're very thankful for that.